But yeah, I think Kim, we can go ahead and get started.
Okay.
Let me just go ahead and say welcome to it's another webinar with AgriLogic. This is our fourth webinar, I believe, with AgriLogic right now in the series. We're going over tree-based dollar amount of insurance programs. If you have any questions, put in chat or Q&A. As always, being recorded and will be uploaded to our YouTube channel, which I'll put a link to that in the chat at the end of the webinar. But yeah, Kim, go ahead and take it away.
Okay, well, good morning, everybody. I've been fighting technical problems right before this, so I think I've got everything loaded. So if for some reason you can't see something, please let me know, because right now it looks like it's showing on my screen. So we're going to be talking today about the tree-based dollar amount of insurance, which is kind of a big title, but basically what it does, instead of covering the fruit, say, for example, apples, peaches, pears, grapes, whatever, it's actually covering the tree, or in the case of grapevine, it's covering the vine itself. So it's insuring the tree or the vine against an insured cause of loss. We're going to kind of get into that. And first, I just kind of want to discuss or mention to you, we've talked about these in past ones. If you've been on past webinars, we're AgriLogic Consulting, and we are working with the Farmers Veteran Coalition to develop these webinars as far as training programs on risk management. Of course, I think everybody here is familiar with the Farmer Veteran Coalition. And this is also being conducted in conjunction with the USDA Risk Management Agency. It's a partnership to educate new and underserved producers. And so we're working with all three of these entities are working together to bring this information to you. Our objectives today are going to be to go over the benefits that are specific to veterans and beginning farmers and ranchers, and then also to go through all of the benefits and the coverages for the tree/vine based dollar amount of insurance program. When you get into the program, it's actually called the tree-based dollar amount of insurance. Vines were just recently added this for 2024, with grapevines being the first ones. And then we're going to have some claim examples on how the program works. So I want to talk first about veteran farmer and rancher qualifications. To qualify for the benefits for veteran farmer and ranchers under the federal crop insurance program, you have to be an individual who served on active duty and were discharged under conditions other than dishonorable. You have to also meet one of the following conditions, in that you've never operated a farm or a ranch, or you've operated a farm or ranch, but not for more than 5 years, or you just in the last 5 years became a veteran, even if you've operated one before becoming a veteran. So the qualifications, you as an individual have to meet those qualifications. If your insured entity is a business entity, that business entity may qualify for the benefits, provided that all of the people that have at least a 10% interest in that entity also qualify as veteran farmers and ranchers. Now, this is not applicable to a spousal policy. When you get into crop insurance, whenever a husband and whenever a person is married, it's called a spousal policy. And if your spouse is not a veteran, it does not disqualify you from the benefits. So what are the benefits? One of them is an exemption from an administrative fee. So every policy that you take out and policies are by crop and by county. So for each county in which you insure a crop, there's an administrative fee. For catastrophic risk protection, this is the lowest coverage you can buy. It covers, there's no administrative fee, and that admin fee is $655. On buy-up coverage, the higher coverage policies, it's $30 for that administrative fee. You'll also, and we'll explain later why CAT administrative fee is so high. It's because you pay no premium. All you pay is the admin fee. So another benefit is premium subsidy is increased by 10%. So every federal crop insurance policy, the government pays a percentage of it, which is called this premium subsidy. And if you qualify as a veteran farmer or rancher, you will, excuse me, I got a frog in my throat. You will get an extra 10% subsidy on your policy. And then when you get into programs other than the ones we're talking about today, we're not going to be talking about these programs today, but under the actual production history programs, it loosens the requirements for you to be able to use another producer's production history. But again, we're not going to be covering those today. And the yield adjustment is not available for dollars for the vine and the tree programs. So this is another benefit that you receive, but again, it's not applicable to the programs that we're going to be talking about today because they don't use a historical average. The beginning farmer and rancher has the same benefits as the veteran farmer and rancher, but the qualifications are different. So you may qualify both as a beginning farmer and rancher and as a veteran farmer and rancher. So the benefits are the same. It's just if you qualify for one or the other. You must have operated a farm or ranch for no more than 5 crop years to qualify under this. Now, if you're taking whole farm risk protection, which is a separate policy, it's 10 years. And they don't count years that you were under the age of 18 years old, or you were in post-secondary school, such as college or community college, or if you were in active duty in the U.S. military. So those years don't count against your 5 crop years. You have to be an individual, just like with the beginning or the veteran farmer and rancher. And again, businesses may qualify provided everybody that's got a 10% interest in the business qualifies as a BFR. Limited resource farmer and rancher. This is applicable to businesses or to primarily individuals that meet certain income and sales thresholds. So your sales cannot be, your indirect gross farm sales can't be greater than this index value that they provide, and it's different for each crop year. And then your total household income has to be at or below the national poverty level for a family of 4, or at least 50% of the county median household income. So again, you could qualify for a limited resource and farmer, veteran farmer and rancher, beginning farmer and rancher all at the same time. What the limited resource farmer and rancher does is it provides some extra technical and assistance programs. And then you also do not have to pay the administrative fee. So again, it's just like beginning and veteran farmer and ranchers in that there is no admin fee. So we're going to go ahead and get started here on the tree-based amount of insurance program. The TDO program, and of course, crop insurance is a government program, and as in anything government, we love acronyms. It's how we live and die, by acronyms. And those of you who've been in the military, I know that you are more than versed in acronyms. So the TDO program for the 2023 crop year, there were 2,200 policies that actually earned premium. Now that there could be more that were sold, but the ones that actually had premium, 2,207. That's a sum of insurance on over 66 million trees that were insured in 2023. And that's about approximately $2.4 billion in liability. And that little box that popped up, it's got the states, the highest states by liability. And so you can see Alabama, probably our highest state is, in the terms of liability, is 138 million in Hawaii, and that's just because of the high dollar amount of crops. So top commodities, the top number of policies earning premiums by commodity, oranges, had the highest number of policies, grapefruits, all other citrus. So these are the trees, not the fruits, but orange trees, grapefruit trees, lemon trees, avocado trees. So all the citrus trees were probably the top commodities that had, as far as the number of policies. Now we went to talking about the number of trees. Orange again is king. Orange trees, 45 million orange trees insured. So you can see far and away, orange trees is probably the biggest commodity in this program, followed by apple and coffee and grapefruit. So there's quite a few different programs out there. When we're talking about liability, of course, with that many trees, we've got orange and grapefruit trees at the top of the heap there, over $1.8 billion in liabilities for oranges alone in 2023. And then as far as premiums, $26 million for orange trees, $5 million on grapefruit trees. That's kind of a recap of the 2023 year, where most of the premium and liability is. Just kind of wanted to provide an overview of the types of trees that are insurable under the program at this time and what states they're insurable in. Just because it's insurable in a state doesn't mean that all counties are insurable. And the sales closing date there on the right, that is the period of time, the date by which you must submit an application for coverage. So we're kind of coming up on the apple tree, avocado tree, carambola tree, so we're coming up on some. The ones that say multiple, it's because in California, there's one sales closing. In Florida, there's another. Texas has a separate sales closing. So didn't put all those in. And as you can see, grapevine is new for the 2024 crop year. And here's just a few more of the tree programs that are out there. So what does the TDO program do? It reimburses the grower an estimated cost to replace the tree or vine that's lost due to the insured peril. And then for example, in the grapevine program, the vine has to be completely destroyed. However, like in the pecan tree program, there's also payment for partial damage. The tree's still standing, but it lost a lot of limbs, fairly good sized limbs. So there's some partial damage payment on some of the programs, not all. The producer is going to insure a percentage of their insurable trees and vines, and that percentage can be anywhere from 50 to 75%. So if you've got 1,000 vines in your 1,000 vines in your grove, let's see, no, that would be a block. You will insure, if you insure 50% of them, that means you're going to be insuring 500 of your 1,000 vines. So there's always going to be a little bit of a policy deductible, at least a 25% policy deductible that won't be covered. When that vine or tree is destroyed or damaged, there has to be a dollar amount that's used to figure out how much to pay the insured, and that's called the tree or vine reference price. And we use that, again, that's kind of a reflection of what we think it costs, or what the program says it will cost to replace and get that tree or vine back up to production. It does not cover the production lost during that time. It's only paying for or covering what it's going to take to get that tree or vine back up to full production again. So a producer's paid if the damage value exceeds the policy deductible, which is, again, 1 minus coverage level. And we'll have some examples of this here. Some of the covered causes of losses, and these, of course, vary by commodity and location. So some of these examples, for example, in California citrus trees, it's primarily freeze, fire, and failure of irrigation. On Florida fruit trees, it's freeze, wind, and excessive moisture. But on Texas citrus trees, we've got freeze, wind, excess moisture, hail, flood, fire, and failure of irrigation. So there's a lot of different types of causes of loss depending upon the tree that you're insuring and where in the United States that you're insuring that tree. Insurance periods also vary by commodity and location. For example, in the Florida fruit trees, which covers most of the citrus trees and some other types of trees such as a carambola, they go from June 1 to May 31st. That's your coverage period. But apple trees goes from July 1 to June 30th, Texas citrus, December 1 to November 30th. So your insurance period is going to be different depending upon the tree type that you insure and where you insure it at. So when you're filling out your application, you're going to have to make some elections on how you're going to insure the crop. The first one, of course, is what crop are you going to insure, which tree, type of tree. And then coverage elections, what coverage level, what percentage of the vines or trees do you want to insure? The published price, we talked about that tree or vine reference price, and let's say it's, $50. You don't have a way of some growers use to cheapen up the premium, to reduce the amount of premium, is say, okay, I'll settle for $40. And so they back down that percentage of price. And in doing so, that backs down the premium just a little bit. And then under the catastrophic risk protection endorsement, there's only one coverage level, and it's 50%, and it will always be at 55% of the price. So as you can see, it's a very low coverage level. When we start talking about unit structure, Basically, it's saying how we're going to group our blocks of trees or vines together when we're calculating amount of loss. So do they all stand together? In other words, we figure up the loss on each block or how much it was over and then determine if there is a loss, or can certain blocks stand by themselves? So that's what we're talking about when we're talking about unit structure. Now, there are rules that apply to that, and there's 3 different types of unit structure: basic, optional, and enterprise. And the reason I didn't go into a lot of description about how unit structures work here is because it depends on which crop you're insuring as to how those units are put together. You know, what defines an optional unit under grapevine may be different than what defines an optional unit under Florida citrus. So that will be something that you would work with your agent to determine, okay, what is allowed and then what would work best for my operation. Another thing that you're going to be looking at is types. So a type is basically we're categorizing the commodity, and there are several different ways of doing it. On the Texas orange tree, the types are early and mid-season, and then late. So there's only 2 types. On the Florida orange tree, there's 4 types: the early mids, the lates, the navels, and the temples. Apples, you've got 4 types: varietal group A through D. So it depends on the crop as to what types are available and how they do those types. Practices, this is kind of looking at growing practices, planting practices, such as what density, high density versus standard density in your planting. Are they own-rooted or grafted in the case of grapevines? Are they irrigated or non-irrigated? And are they going through transition into organic, or are they certified organic? So those would be your practices that you might be looking at and that you're going to have to elect on the application. We also look at stages. So if you think of a brand new, you're getting ready to insure a brand new block of trees that have just been planted, that is a lot different than if you've got an existing block of 15-year-old trees. The amount of insurance is going to be a lot less for those small trees because it doesn't, you haven't invested as much time and money in those smaller trees. So we look at the growth stage, and it could either be by age or it could be trunk diameter, depending upon the commodity. It also looks at management practices. So if you've got existing trees and you've done some buckhorning work or top working, that may make them into a younger stage than, say, the actual age or trunk size that they are. So there's separate reference prices depending upon the stage they're in. And it depends on the commodity as to what stages are available. In grapevine, stage 1 is set out through 12 months. And stage 2 is up to 48 months. And then stage 3 is 48 months and above, with the idea that at 48 months, that grapevine is back up to full production. But you can see a macadamia tree, there's 5 different stages depending upon the age, because again, it represents, this is for the pricing, and it represents what it's going to cost to remove and replace, or in some cases, what it's going to cost to repair or reset and get it back up to full operations. So some options that may or may not be available depending upon the commodity. Hail and fire exclusion, which basically says we're going to exclude those from coverage under this policy. That's primarily used to try to cheapen up premium. I really haven't seen a lot of people use that, but I suppose it's possible. In apples, fire blight, in some areas, fire blight is a mandatory part of the policy, and others it is an option. And then occurrence loss option. And basically the occurrence loss option, it slows down the pay or the application of the deductible. And I'll have an example here. It's really hard to kind of talk about it, but basically the only deductible that's going to be applied against the loss is the deductible that's applicable to the destroyed vines instead of the entire deductible for the whole policy. There are minimums, so the block or the unit must have sustained at least a certain percentage of damage. And this isn't available with a CAT endorsement. Again, remembering that the CAT endorsement is minimal coverage. So I do have an example of the occurrence loss option here at the end. Comprehensive tree value endorsement is an endorsement that you can add on. And earlier in this presentation, I had mentioned that we're only covering what is expected to get the tree or vine back up to full operation. However, when you lose a tree, you also lose revenue during that period of time because, of course, it's not producing. So that you can also purchase on most commodities, not all, the comprehensive tree value endorsement. So it just compensates for a portion of the revenue that was lost because of the death or destruction of the tree. Again, it's not available with the CAT endorsement and only available for trees that are producing at commercial levels. So this is kind of a CTVE illustration. You've got years 1 through 9, and you can see as those trees are getting up to their maturity, that there's income that's lost during that period of time. And so that's what the CTVE does, is it kind of helps replace that income that's lost during the time that the tree is being either growing because it was replaced or it's being rehabilitated. So this is a pecan tree example here. So you can see in year 0, the pecan revenue policy, which is a totally separate policy, it will help out with the loss during that first year, but the CTVE starts off paying for 100% of that lost revenue, but then that as the tree starts providing production, that starts providing the rest of the income for that lost tree. So it's just a way to kind of try to buffer some of that loss of lost production, and especially important when you get into the trees that take a lot longer to get up to production. I want to talk a little bit about the tree reference price or the vine reference price. If you're talking about grapevines, it's basically the price, and there are different prices by stage, which again, thinking about either age or trunk size, and by the type. Thinking about an orange tree versus a grapefruit tree, and practice, standard density versus high densities, things along that line. So there's going to be separate prices for each one of those, depending upon the commodity that you're insuring. But it's basically used to calculate, how much insurance you have and what was the damage. So that basically tells you what you're going to be reimbursed for the lost tree or vine. So the first thing that we figure is the amount of protection. And so we take the number of insurable vines or trees. So let's say I've got 1,000 in my block, and we take that times the tree or vine reference price times whatever coverage level that you selected, and that is your amount of protection. Your premium, we're going to take that amount of protection times your share in the commodity. So let's say you only have 50% share in that grove, then we'll take it times 50% times the premium rate, and that gives us our gross premium. And the gross premium is, if you were buying this policy, this is the premium that you would have to pay. However, since it's a federal crop insurance program, we're going to deduct the subsidy from it. So you're going to take that gross premium minus your subsidy to get your net premium. So when we're talking about subsidy, it's the percentage of the premium that's going to be paid by the federal government. And the subsidy varies by unit structure, coverage level. And again, remembering if you're a beginning farmer, beginning or veteran farmer or rancher, you get an additional, this is where that additional 10% comes in. So you can see in this example, hopefully you can see, hopefully your screen's big enough, but under optional units at 65% coverage level, the federal government pays 59% of the premium. But because you qualify as a veteran farmer and rancher, they will pay 69% of the premium, and that means that you'll only be paying 31% of the premium, if I did my math right in my head, which I don't always do. But anyhow, having said that, So these are the subsidy factors, the amount of the premium that the federal government will be paying for your premium, for your policy. Now, if you look at basic unit where it says cap 1.00, that means that the government will subsidize 100% of the premium for catastrophic coverage. That would explain why the administrative fee is $655. But again, if you qualify as beginning farmer and rancher, you don't have to pay the admin fee. So there's, as I mentioned earlier, there's an admin fee for each crop within a county, $30 for buy-up, $655 for the CAT. And again, it's 100% subsidy on premium. And that fee is waived if you qualify as a beginning or veteran farmer or rancher, or you are qualified as a limited resource farmer or rancher. As far as reporting, there are a couple documents that you'll have to fill out in addition to the application. Of course, the application basically gives your information, your name, address, etc., and what coverage elections that you plan on taking. Then there's what's called a producer's acceptance worksheet. You'll hear some agents refer to it as a pre-A, some refer to it as a PAW, but either way, it's your certification as to the condition of your grove, orchard, or vineyard. You'll also complete an acreage report, and that just shows, just provides the number of trees and vines that are needed to calculate the guarantee premium and liability. Some policy basics. So my unit damage value is something that the loss adjuster will come out to determine. And basically it's the number of insured trees or vines, and I'm just going to say trees here just to make life easy. So number of insured trees that I have, remember my example, I had 1,000 trees. I insured them at 75%. So I got 750 insured trees. Take that times the tree reference price, times again the percentage of that price that I elected, times the percentage of damage. And that percentage of damage is the amount that the loss adjuster determined when they came out and inspected your trees or vines. We subtract the unit deductible from that. So the unit deductible is the number of insured trees or vines times my percent of price times one minus the coverage level. And this, if 1 minus 75%, it's 25% is going to be my deductible. Take that times share under report factor, and that gives I'm sorry, I need to back up. That gives us our indemnity. I want to back up to the under report factor. It is really important when you're doing a tree or vine policy that you report the number of trees, vines accurately, because if the loss adjuster during his inspection finds out that the amount of vines or trees that are in the block is more than what you had reported, there will be an under-report factor, and that will reduce your indemnity. So it's really important to make sure that you get those reported correctly. So we're going to go into some examples and resources on this. A notice of loss, basically, if you have damage to your trees, you need to file a notice of loss to your agent. The AIP, which is the insurance company, has agents that you'll be working with, and you need to submit that notice of loss to your agent by the deadline in the policy. And again, this varies by crop, but my recommendation would be as soon as the storm has passed or whatever has happened, make sure you turn that notice of loss in. Now you can't remove any vines or damaged vines or trees until that loss adjuster has come out and inspected that damaged crop. And inspections occur within 10 days of you filing that notice of loss, unless they'll work with you on that. The loss adjuster will give you a call and they'll try to get out there as quickly as they can, but sometimes you can't get in because there are trees down, so they get in there as quickly as they can. So they're going to come out and they're going to determine how many trees were destroyed, how many were partially damaged, if the policy has coverage for partial damage. Again, grapevines do not have partial damage. So they're going to come out and determine what your losses are, and so that your indemnity can be calculated. So we're going to kind of go through an indemnity example here. I guess I should probably stop and ask if anybody has, I always ask people, to turn off their phones when we're doing a training class. And what did I do? I forgot. I guess this might be a good spot here before I start into this indemnity example to see, do we have any questions, Brandon, or?
No, Kim, there's no questions yet.
Okay, good. So that means that I've either totally confused everybody or I've been really good and everybody's really clear on what we're doing here. So we're going to walk through an indemnity example. We're going to look at a grapevine indemnity. So I have 10,000 vines in my block and I own all of I have 100% share in them. I elect 75% coverage level, and I think that vine reference price of $20 sounds pretty good, so I elect 100% of it. And I haven't had any previous damage or claims on this grapevine. Then I have an event. Let's say it's a untimely freeze, and I have an actual number of vines is 10,000, but I have 40% of them were destroyed because of this untimely freeze. So we're going to, first of all, figure my underreporting factor. And because I did a really good job on my acreage report, I reported 10,000. And when the loss adjuster got out there were 10,000 out there. So there's no underreporting factor on that. My damage value is 10,000 vines times the $20 VRP times, again, 100% of that VRP because I like that $20 price, times my 40% damage. So we're basically saying 10,000 vines at $20, that's the value of them. And then 40% of that was damaged. So that's $80,000. My unit deductible. So my unit deductible is my 10,000 original vines times the $20 times my 25% deductible. So that's $50,000. So if I take that 50 out of that 80,000, my damage value is $30,000. And then that's also my indemnity because I didn't have any underreporting factor. So, and I had 100% share. If I only owned half of those vines, then I would have had $15,000. So that's kind of it, really simply and easy with no hiccups or major problems. So now let's talk about OLO, the occurrence loss option. So I'm going to use the same exact example. So that way you can kind of see where it makes a difference. When I'm doing it again, I look and see, make sure that I reported all the vines that are out there. And then there's a qualifier on this. So basically it says you had to incur at least a 5% loss in order to qualify for a payment under OLO. So I got my 10,000 vines at $20, 75% of them are coverage, and then I take a 75% coverage level, and I take that times 5%. So my qualifier in this case is $7,500. My loss has to be higher than $7,500 for me to qualify. My damage value in this case is $80,000. So I more than qualify under this example. My amount of, and going back to the damage value, it's the same way we figured it with the previous example, 10,000 times $20 times 40% damage. My amount of insured damage, and this is where the OLO changes how this indemnity is calculated. We're going to take that $80,000 times 75% coverage level. That's our amount of insured damage, and that's going to be our indemnity. Remembering that the previous one was 30,000, this is going to be 60,000 because instead of reducing that 80,000 by the full deductible for all 10,000 vines, we are only going to be reducing it by the 4,000 vine, the deductible on the 4,000 vines. And so that works out to be a $60,000 indemnity. Oh, let me go back a little bit. So that's how the OLO works. Instead of reducing your damage value by the full deductible, you're only reducing it by the deductible that's available or that's applicable to those vines that were damaged. What it does is it slows out the payment of the deductible or the application of the deductible. Now, if at the end of the year you have multiple events and you end up with 100% loss, they're both going to, end up at the same, you're going to end up at the same place, 100% of your insurance coverage. But if you only have one or maybe two smaller ones that, again, are higher than the qualifier, it will pay those out a little quicker because we're not taking the full deductible at the time of loss, only the deductible that's applicable to the vines that were damaged. Sometimes I do better with graphics. It helps me to understand just a little bit. So using that same example that we just did, that we just walked through, remember, I had 10,000 vines. That's what the middle bar, oh, you can't do that with, sorry about that. The middle bar there, the blue and gold, that represents all 10,000 vines that I have out there in my block. 4,000, 40% were destroyed. So on my left is without OLO. I've got 2,500 vines at 25% deductible, and I got 1,500 vines because that's what's left after I reduce the 4,000 vines after I take off my deductible. With OLO, my deductible is only 1,000 vines because it's only deductible for those 4,000 destroyed vines. And then I'm paid on the full 3,000 vines that are left. I hope that makes sense. OLO is very difficult until you work through the math. For me, it was very difficult to understand with conceptually until I worked through the math. I did not include a CTVE example because of the complications with CTVE. That's something that takes a little bit longer, and you really need to be working one-on-one to understand how CTVE works, and it's very specific to crops. So we did not include a CTVE example in this, but your agent can help walk through an example on that. So that is all I've got on the tree and vine-based programs. Any questions that we have, or anything anybody has questions on for those? I would like to mention too, if you are a small producer, there are no minimums on these policies. For example, let's say you've put out, 500 vines. There's not a minimum amount that you have to have. There are some minimums sometimes on certain things as far as how many vines per acre or trees per acre that you have, but there's not a minimum number of acres or vines, so to speak. I'm trying to remember, I think on vines, it was 600 vines per acre or something along that line. But anyhow, any questions on what we've covered here or anything that we can help you with?
I'm not seeing any questions, Kim. You did good.
Oh, good. Well, at least I worked, and even though my technology didn't work, at least I worked. So if you have any questions, please let Farmer Veteran Coalition know, and Diego will be he always forwards on any questions that anybody has. And so just please let him know, and we will be glad to get that information back to you. That's all I got, Diego.
Thank you for that, Kim. And like I said, if you have any questions, feel free to reach out to us at support@farmvetco.org, as you can see there. This is being recorded again. It'll be uploaded on our YouTube channel within the next week or so. Be on the lookout for our next webinar with AgriLogic next month. We'll be going over general liability and record keeping. We know that's a big topic for our members, so please be on the lookout for that. And if you have any questions, again, just reach out to us and we'll help you out. But thank you, Kim, again for another webinar, and we'll see y'all next time.